Good morning, everybody, and welcome to another Playbook Small Carrier Market update where I come in and bring you what we're seeing over the last 7 days in regards to sonar data and how that impacts small carriers specifically. As you know, small carriers, we dominate the industry. We're comprised of over 95% of the industry, and I wanted to give a platform where small carriers can see data that really impacts them to make sure that we can unpack it in a digestible format, what's most important, and really kind of stay ahead of things. So today I'm going to share with you some of the things we've seen over the last week. Some of the things that come as a little surprise to you. Some of the things may not, but I definitely want to make sure that you keep on keeping on. So let's get started on where we always like to start, right? The outbound tender rejection index. If you have been following this show or this segment for quite some time, you do understand the meaning of the outbound tender rejection. But if you don't, I'm going to give you a really quick update on what that means. What this basically means is that any opportunity that a contracted carrier that's on a contracted lane rejects a load, it becomes part of this index. The higher the rejection, meaning the higher amount of loads that contract freight is actually rejected, that means it has nowhere else to go. And the only place that it can go is onto the spot market. So the outbound tender rejection index means the higher that rejection index, the higher amount of freight that goes onto the spot market. On the graph that you're seeing on the screen, I wanted to give you a rolling 365 viewpoint so that you can see truly like where we're headed as far as from a trajectory standpoint. As you can see back in December 2025, where outbound tender rejections were extremely high at that point, they were over 10%, and things felt like we were headed in the right direction. Well, we've seen that cooling take place throughout the entire 2025. We're down to a 607, which really is settling in after most of that demand that we saw over the last couple of weeks were holiday driven. So we obviously see that we're moving into a more of a normal non-seasonal place. Tender rejections dropped off from a post-holiday peak of 7.72 to 607. This just confirms what we talked about. It was all seasonal. There was nothing really that was going on behind the scenes there. Current level is back nearing that early June range. That means that obviously we're just getting back to more normalcy, and that spot market pressure is easing slightly as that contractor freight gets accepted again. Rolling down to that 607. That 607 is the lowest that we've seen again since mid-June. So it kind of tells us that things are starting to just level back out where they were before. Still stronger than we had earlier this year, where we were in the fives, like in the May, April, late May, April. We saw a little bit of that in that March. Little in February, still stronger than that. So obviously we're in a little bit better place than we are at that point. But nevertheless, I wanted to give you some insight on that. The next chart I like to show for our small carriers is outbound tender volume index. Again, if you've been following this segment or if you're following this update every single week, you know what the outbound tender volume index means. If you don't, I'm going to give you a 5-second review on what that means. It basically means the amount of volume, the amount of loads that are available. And the higher that number is, the more loads that we have available. Now, the thing about where we're at right now is we just come into a slight rebound where we're down in the nines not too long ago in early July. Just a little bit of a volume rebound there. We have some correction from the 4th of July. I mean, hey, pretty much warehouses are back online, right? Shippers are back online. Places have closed that were closed have reopened. Back to business as normal. We're still not in a strong place when it comes down to the index. We're just in a normal place on what I see. If you look back over a year ago, we were close to 12s. We were getting up in that high 11s for a much more consistent place. Volume is down. So just wanted to be really clear that I don't see any clear momentum towards any peak season surging just yet. I think holding above that 10,000 mark is really key. If we slip below that, then that's going to let us know that we're having even more volume softness. And then we can definitely expect to see rates to fall within that as well. So just wanted to make sure you had a clear viewpoint on that. Then we go into our national truckload index, exactly what it is. This is on the dry van side. So you can see the dry van average. This is all in the dry van rates are flattening again, right? So we're seeing rates flatten out again. If you look at it, we're down into a 232. The NTI has down. We had a high. Obviously, that high was driven by the 4th of July. that activity again based on this chart and another chart that I showed you earlier. This is all reflecting that cooling. We're still back in that late May, early June period, right in that 220 range where we're down in that place. So really don't feel like they're going to be a significant increase in that, especially if you look back on a previous chart when we talk about volume. Without volume, obviously volume is going to drive that demand. And without that demand for trucks, right? So we can just say what it is. Without that demand for trucks, I don't anticipate a significant rate change in the near future, and that's just being transparent, right? So we're talking about, we have some models that we ran where it shows potentially 220 or below by August. So I want to prepare you. I don't want to get out here and doom and gloom. I'm not fear mongering. I'm not doing none of that. I want you to be prepared. I don't want to scare you. I'm just going to tell you what I see. If I'm wrong, I'm wrong, and I'll be glad to be wrong when it comes to something like this. But right now, I just am not seeing a significant change vertically in the National Truckload Index. But what I am seeing, I'm seeing a rate rescission, which I hope that I'm wrong, but just based on these things, these charts that we're seeing, it shows some softness. So without that pressure from volumes or rejections, again, rates are at risk for dropping lower.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. The people that I see most successful in this business operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the Freight Waste Playbook.
As we go into diesel prices, they continue to rise for the third straight week now. We're at our 4-month high. National diesel prices have jumped from $3.73 up to $3.73. We're close to 30 cents up from June, which is a significant increase. This is the highest level since February, and this is a significant swing. Obviously, having carriers pay nearly 30 cents more per gallon versus just a couple of weeks ago is significant, especially as we stretch out this term a little longer. And as rates become continuously stagnant, I think that we'll see long-term and short to long-term, if we don't see a better rate environment, then we'll see more carrier exits as we go through. So this is traditionally another continuously thing that we have to keep our eye on. And the one thing that I want to make sure that you are familiar with. Putting the chart up on the screen, as you know, every week I like to put the chart on here so that way you can see spot range changes over the last 4 days. Blue to blue is really good. Anything in the red is not so good, obviously. So as you can see, some of those blue zones where we see those rising rates, some of that Midwest market, so up in your Michigan area, kind of right outside that Wisconsin, a little bit at north on the Illinois side, we see some slight upward movement, much more on the West Coast. So as you come in almost the entire state of California, which is an indication of what we've seen from the TEUs. Again, TEUs, we're talking about imports. That would definitely encourage the information that we've had for that. It definitely kind of reflect that. And as we can see that West Coast freight coming on, we can see spot rate changes, obviously, as we see that. Your red zones, which, the Southeast was strong for some time now, man. There was a lot of you guys were eating off of the Southeast, and ladies were eating off the Southeast. But now we're starting to see rate declines. So you're going to have to change that strategy. Like what we were doing 3, 4, 5, 6 weeks ago is not going to work anymore, because we're seeing a significant rate decline and a sharp rate decline in some of those areas that we've been operating in. So small carriers, make sure that you're positioning yourselves in a different place. And then again, we talk about survival, and part of survival is being uncomfortable. And sometimes in those uncomfortable situations, you have to do what you have to do in order for you to stay above water. Right now, our West Coast carriers running that West Coast has shown a significant switch. Not saying my East Coast carriers go to the West, but I'm saying East Coast carriers, just be mindful of where you're operating in. even if you go into that kind of that tan range, you see where those tan areas are a little bit. You see that tan in that northeast. You see a little bit of tan west over west up north, in the Ohio Valley area, that Mid Atlantic. You see a little bit of that stuff. That could be a good position in place for you. But what I'm gonna just tell you now is that you just got to be very, very strategic in where you go and make sure you're mapping out and planning out what you're doing. So leverage this map to chase that margin. Use this information to make better decisions. This is what we've seen over the last 4 days from a hot, cold place. So make sure that you're positioning yourself accordingly when it comes down to that. Now, reefer rejection rates are starting to fall, which is, obviously they're elevated and they're better than the dry van side, but it's certainly not what my reefer carriers wanted to hear. Rejection rate dipped from that 13 to 1175. You're still significantly higher than the van side. So obviously reefer capacity is a lot tighter when it comes down to it. We have less reefer carriers than we do dry van carriers. So we have more opportunity for reefer carriers. But that July spike is starting to fade fast, and that capacity is rebalancing over that. So the overall reefer market appears to be much more stable than van, but that's not saying a lot when it comes down to it. So I just wanted to keep you mindful of that. Reefer rates are definitely holding decent, but they're losing steam. So when you look at where they are in comparison to, let's just say, late February, early March, they're elevated when it comes down to it, but it slipped from that 270 to 266. That obviously confirms what we see as far as produce season, but it's still performing better than the van segment in per mile earnings. So it's still a better place for us. There's no sign yet of a second wave of that surge yet, so I'm not seeing anything that would drive demand. And then obviously fuel costs are pressuring those margins more heavily at 30 cents a gallon higher. Obviously, another place that I wanted to share with you is the carrier net authority changes. After we've seen a significant change, I don't want to even say significant change because we're doing this every single week. It seems much more significant as you do it weekly than as you do it over a longer period of time, because it gives you the opportunity to have pluses as well as minuses to give you a better balance. But now for this week here, we had another net gain in active authorities. This week, we saw a net gain of 120 authorities, which is a reversal from last week. We got 463 new authorities were granted, which is up 134%. But this is the only third net positive week in the last 11 weeks. So that shows a little bit more of some resistance when it comes to joining the market. The overall trend remains net negative, and we've seen that net negative trend for quite some time. And obviously, with that being stated, this is our first full month of the ELP mandate. I'm not seeing a lot of change in terms of authority counts when it comes down to that mandate. Nothing really has significantly jumped off the charts in that. But despite the gain, the overall trend remains net negative. So it's something to continue to watch as we go through it. And then last but not least, I wanted to share with you inbound tender when it comes to inbound freight that's coming off of the ports. And this is a true indicator on volume on our side. Ocean imports have slipped slightly after a strong June. We've seen a dip after a strong late Q2 surge. The volume is still above the Q1 lows like late February, and then a little bit after mid-March, early June. But we're starting to see that stuff kind of cool off. This is that first pullback in a few months, and it could just kind of signal that, this is where we're at a plateau in terms of volume. Now, remember, it's a 2 to 4 week lag before we see that in overall trucking volume. So again, what you see now, we'll see that lag 2, 3, 4, sometimes 5, 6 weeks down the road when it comes to that lag. So just wanted to make sure that you're mindful of that and you're watchful of that. So this kind of gives you the best indicator when it comes down to what you should expect to see over the next couple of weeks. Love doing these. Love making sure that you stay informed with this information. Please make sure that you take this information and not just watch it just as an entertainment perspective, but make sure that you're using this to put into your plan. I hope you have a safe and be smart this week. The safe profitability is the key to the game. And I'll see you on next week's market update.